Hello, everybody. We're going to get started today. Just want to keep everything on time and moving forward. We have a lot to cover today. So thank you for joining us for today's lunch presentation, as we're always looking to keep you updated and informed. This is the third of our series in Planning with Purpose: What Drives Value? So glad everybody is here today. Our experts are going to explore why it is important and how to calculate the business valuation. You know, at what point do you need to have that done, or should you have that done? And what does it mean? How do you calculate it? Are there different ways to calculate it? Things like that. How does it all get impacted? So we're going to go through that today with our experts, and I will just do some quick housekeeping before we start and I turn it over to them. As you know, there is a toolbar, should be on the right-hand side of your screen. You can go to the handout section, get a copy of today's presentation, also the bios of our experts. And there is a question section. You can submit questions at any time throughout the presentation. We will get them answered for you, and either during the presentation or after. As soon as we're finished today, you will get an exit survey. If you could please complete that, let us know how the presentation was, if you have any additional questions, or if you'd like to meet with one of our experts one-on-one, you can note it in there. And then this afternoon, I will send an email to everybody with a link to the recorded session so that you can listen to it again or share with a friend. So let's get started. I think you know some of our experts here. We have Al and Adam today talking about the valuations. They are both have CPA licenses and also ABVs, so that's why they are experts and go in this particular section. I do have one poll question before I formally turn it over to them, just to help us understand the audience a little bit better today. I don't know why I can't find my words, but hopefully we can get this up here. So just to see kind of where we are and who our experts are talking to, what have you done in the past? Have you done a valuation before? You've never done it, you've started it, maybe never finished. Where are we at? Where do we think they're going to be, guys? Where are you hoping that they're going to be?
Hopefully never completed the valuation. So this will be a good learning experience.
Okay. Give everybody just a couple more seconds. If they haven't done it, they'll get the information today and they'll be able to get it started next week, right?
Right. Ready to go.
All right, I'm going to close this out just so we can keep things moving. I'll share real quickly today. 70% never completed it, but have heard of it before. So I think that's a great audience for you guys. And 30% have completed it recently, but want to get some more information. So with that, I am going to pass it over to you, Al, to get us started.
Thank you, and good afternoon, everybody out there in webinar land. Just a quick overview of what I want to cover today with Adam. I'm going to give you a quick summary of all the different valuation approaches that we take as ABVs when we prepare a business valuation. From there, I'm going to hone in on one specific approach, the income approach, and then dive deeper into the key concepts that we use in the income approach, as this is the most commonly used valuation approach that we implement. And then once I kind of set the table on the use of the income approach and the key concepts of the income approach, connect the dots back to the key value drivers specific to your business or the business unit you're looking to acquire, so you can see how those are interrelated, and then use that to enhance your knowledge and make a good decision if you're looking to acquire a business, or enhance the value of your current business to set yourself up for a good future. Slides not moving.
All right.
Okay.
There we go.
All right. There's three specific approaches that we use when we prepare evaluation. The first being the asset approach. And as it says there, this is a focus on the net asset value of your business. And we calculate that by subtracting the liabilities from the assets. So it's, really looking specifically at your balance sheet. We don't often use this approach because number one is it usually undervalues your business. We're not accounting for any intangible value. We're not accounting for any goodwill when we look at the assets specifically. And we're really only using this if your business is unprofitable or the cash flows that you're generating from your business really don't support the assets that you're implementing to generate those cash flows. So, the highest and best use of those assets, you should be creating cash flows sufficient enough to make it worthwhile to use those assets to generate those cash flows.
Yeah, so even though this is a simple valuation approach, I guess in theory, I value my assets, I take on my liabilities, that's what I'm left with. It's not a great approach when trying to determine the value of an operating business because the value of those assets are in producing future revenues, not necessarily liquidating them and realizing that their current values.
Right, and that's the whole point of why you're operating a business is to produce future cash flows and to create value for yourself with those periodic cash flows. The next approach that we can implement is the market approach. There's two specific approaches we use within that market approach. There's a guideline public company method, which is kind of what it sounds like. We look at public companies in a similar industry as your business. We come up with market multiples, based on stock prices of those publicly traded companies, and we use those multiples and apply them to your business to come up with a value. And then similar with the merger and acquisition method, we look at a database of private sales of businesses in the same industry and come up with market multiples from those recent sales and apply them to your business. The best way to look at this, or like how I like to look at it, is if you are purchasing a home or if you were looking to sell your home and looking at market comps for similarly sized homes. So if you have a 3,000 square foot home, you look at a 3,000 square foot home that's sold in your neighborhood recently, what did that sell for? That gives you an idea of what your home is worth. And obviously there's limitations to that, and there's limitations to the approach under a business valuation, similarly. So if I'm looking to sell my 3,000 square foot home and I'm looking at a comp from a home that sold down the street, I don't know if that home needed a new roof. I don't know if that home needed a new furnace. I can look at pictures online, but maybe the whole kitchen needed to be renovated because it's outdated. Like, I don't know the specific attributes of that house, so I can't really compare apples to apples necessarily, but it does give me a rough idea of what the business is, what that home is worth. The similar can be said of using a market approach for your business. I don't know the customer concentrations of that business in that database I'm looking at. I don't know if they have a good management depth or not in that business I'm looking at as a substitute for my business. So there are limitations. Public company method we don't often use either, just because public companies are 100 times larger than the businesses that we're usually valuing.
Yeah, and I think from a theoretical standpoint, the market approach is probably the strongest approach to use. Right. When valuing a business. Really, it's comparing actual market behavior, readily available market quotations, transactions. So really, in its truest sense, this is the willing price between a buyer and a seller. However, as Dale alluded to, for some of these privately held or closely held business, privately owned or closely held businesses, we have trouble finding a comparable. And you might think, well, there's this great public company out there that sells the same product I do. They're also not dealing with the same risk and the same struggles. So, using solely those multiples is probably going to provide you with, misrepresentation of value. Whether it's, these public companies have more diversified revenue streams, stronger brand recognition, just things like that these smaller privately held companies, don't have the benefits of having.
Access to capital,
access to capital, robust team of management, that's a big one. It's used as a reasonableness check, right? In most cases.
That's one I most often use.
Yeah.
Just check a reasonableness of all of our inputs that we come up with ourselves. And then finally, the income approach, and what we want to focus on today. There's two different methods we use of the income approach. There's the discounted future benefits method, and there's the capitalization of benefits method. We'll get into the specifics of each of those in the next few slides. But we usually use this to value the small business And small is a relative term. I would say we're valuing businesses in the $2 million to $100 million range. It's a wide range, but I would say those capture most of the small businesses that we're valuing in Buffalo and Western New York and the surrounding area.
Yeah, the value being with the income method is that, expected free cash flow in the future. That's where I'm deriving that value.
And just to quickly define what future benefits are, they can be defined, a number of different ways. You can define future benefits as your net income before or after tax. You can define it as your EBITDA, earnings before interest, tax, depreciation, amortization. You can define it as seller's discretionary earnings, which is essentially EBITDA plus owner's compensation plus non-operating income and revenue, or income and expenses. I'll get into in a little bit. And then cash flows, you can also define future benefits as, and I bolded and underlined it in this slide because that is most often what we are honing in on when we do valuations is cash flows. I'm sure you've heard of the term cash is king. Cash is essentially what flows into the investor's pockets. It's what they're left with at the end of the day. Net income doesn't necessarily represent your actual return, neither does EBITDA, so that's why we focus on cash flows. So I kind of alluded to these two different methods and how they are interrelated. The key really being that you use a discounted future benefits method when you have a period of uncertainty, but it essentially leads into the capitalization of benefits method once you get to that dotted line on this chart, this graphic, which is the point basically of maturity of the business or at a period of sustained continued growth into perpetuity. So you can see I put together kind of two different scenarios, one in a black line, one in a green line, that ultimately lead to a steady growth black line there on the right side. That black line that goes up and down, that was something that we actually saw a lot during COVID, and with auto dealers specifically, you can see we had steady growth from year 1 to year 2, or in years 1 and year 2, and then a huge decline in year 3, which was kind of what happened with auto dealers, in that the economy was shut down with COVID. People weren't going to buy cars, but then all of a sudden the stimulus money got pumped into the economy. Used car prices started going way up. New car prices started going way up because there was a lack of supply and high demand, supply chain issues. So now that all of a sudden caused a rapid growth in the auto industry. And then we got to a little bit less, rapid growth and kind of tailed off. And then we got back to kind of a steady state or a more normalized level of earnings. Same can be said of that green line, which is a different scenario, but similar. You have a short period of exponential growth that you aren't going to sustain long term. But if you don't capture this in the discounted cash flow approach first, you're going to understate the value of your business. So that green line really represents almost like a startup company. Its first few years in its infancy, it's slowly, it's developing its product, it's building its customer base, and all of a sudden its product takes off, its services take off, you have exponential growth, then you get to your maturity in period 6 in this scenario, or whatever period it may be, and then you reach a steady state of growth. Now getting into the mathematics of this, a business valuation is really just the valuation of an annuity. An annuity is a series of periodic payments over time that you present value and then sum up. And so that's what that red formula is at the bottom there is discounting those earnings in years 1, 2, 3, 4, 5, and 6, and so on into year 10, divided by 1 plus R representing the discount rate. So if you go to this, to the right-hand side of the chart, you can see where we implement a capitalization of benefits method where you are in a period of sustained steady growth. And what you can do is you can shortcut that formula and rewrite it as present value equals earnings over a discount rate minus a growth rate. And if you are bored one day and you want to open up a spreadsheet, you can actually put in these formulas and you can see that if you were to grow E1, E2, E3, E4 at a steady growth rate and divide it by 1 plus R steady discount rate, you would get the same result as if you just use the formula earnings over risk rate minus growth rate, which is called the Gordon growth model. So that's a little bit about those methods and how the math works and the theory works. And I'm going to pull apart this, the formula a little bit more, so we can you can kind of then start to see how we get to these value drivers. So like I said, the Gordon growth model is your earnings or your cash flow over your discount rate R minus your growth rate. You can restate that as future benefits over capitalization rate. I said previously, future benefits can be defined however you want. In this case, I like to use cash flows. We always use cash flows. So let's say future benefits equals cash flows. And you can restate R minus G as capitalization rate. And then, you know, with the mathematical formula, if you divide by a number, you can also multiply it by the fractional equivalent. And then if you take a look at that formula, future benefits times 1 over capitalization rate, you can also say future benefits times a multiple, like I said, you know, previously using the market approach, you use multiples. And I'm sure if you've done research, you know, for the 70% of you out there who haven't had a valuation done, but you may be interested in what your business is worth, you may have done some Google searches, you may have looked at some industry periodicals or whatever it may be, and you see certain multiples that are assigned to your industry. You may see like a 4 times EBITDA or a 3 times SDE, seller discretionary earnings, or a 3.5 times cash flows. So that's your multiple. Your multiple is 4, 3, 3.5, which you can also, you know, restate as 1 over a capitalization rate. So knowing, you know, what a multiple equates to, when we get to the capitalization rate, we can kind of, you know, you can kind of start to see how a multiple is derived. What does a 4x mean? Why is a 4x even a multiple? What goes into that multiple?
Yeah, and I think even if you have a mature, steady company, there's times where the capitalization of benefit method is not the best choice, right? If they're expanding into new product lines or new markets where, you know, revenues in the future and costs might be different, you might have to go through and project those out to level that into the perpetuity.
Right. So, I mean, essentially what you're trying to capture with this discounted cash flow method is capturing the variability in your cash flows in that period 1 through 5. Like Adam said, this could be in periods 6, 7, and 8. But you need to make sure you know in your forecast period where that variability is until you reach a steady state of growth. So you're not undervaluing or overvaluing the business based on some short-term variability in earnings, based on things you may or may not be able to control. Okay. So now let's actually get into the value drivers. I kind of set up the background here in the formula, and you can see the different gauges, and then the formula below each gauge. So like I said, value equals future benefits times 1 over capitalization rate, or as can be stated, 1 over discount rate minus the growth rate. Now I purposefully set up the value drivers in those gauges like they are in those colors, because you can see an increase in cash flows, results in an increase to your value. A decrease in your discount rate equates to an increase in your value, and an increase in your growth rate relates to an increase in your value.
Yeah, strong, you know, recurring and growing cash flow is probably the most significant driver of value. I don't think that comes to a surprise to anyone.
Yeah. Discount rates and growth rates are pretty subjective. Cash flows aren't necessarily as subjective. The future outlook and the forecast of future cash flows is somewhat subjective. But at the end of the day, if their financial performance is what it is, it kind of speaks for itself. The discount rate and the growth rate are things that you can kind of argue up or down and have a little bit more subjectivity to, and which you'll see when we get into the detail of those. So let's start with the first value driver, that's cash flow. So what do we generally look at from a business valuator's perspective when we're trying to value a business? And we start with the first half of our formula, or the first third of our formula, cash flows. And what should you keep in mind as the business owner or as a person looking to acquire a business is those 4 items I've kind of bulleted there. You first want to start with a historical analysis, and that's what we start with. We usually take a look at about 5 years. 5 years is generally what we like to look at. It kind of captures an economic cycle. And what we do is we plot out your 5 years in a 5-year spread, and we look for trends. And then looking at those trends, we look for non-operating income or expenses or non-recurring income and expenses within a historical analysis to kind of smooth or clean up your cash flows, so I can figure out, what can I expect in terms of cash flows in the future if I were to run this business clean without non-operating, non-recurring items. So what do I mean by non-operating and non-recurring? So non-operating items generally, officer perks. If you if you have a vehicle that you don't necessarily need for the business, that you are paying for the gas and you are running your auto lease payments through, that would be one that we would pull out. Maybe you have investments on your balance sheet, and then the income from those investments is flowing through to your P&L and flowing through to your cash flows. We would pull that out from your cash flows because that's not related to your operations, your core operations of your business. Now, we would add those investments onto the total value of your business after we calculate it, but for the sake of the discussion today, just know that we would pull out that cash flow from your total cash flow.
It's separate from determining the value of the operating entity itself.
Other non-operating items, PPP, ERTC money, we've been seeing a lot of that the last 4 or 5 years. We've been doing valuations. We pull all that out. That's non-operating type of income. And it's also non-recurring income. Some examples of non-recurring income and expenses, similar to PPP, ERTC, but not so similar. Maybe you had a legal settlement with a customer, or you had a legal settlement where you had to pay out to a vendor, or whatever it may be. You had a one-time expense. It's not going to recur. We don't expect it to happen again. When I did an auto dealer valuation, they received a big settlement or insurance proceeds because they had a hailstorm and it wrecked half their inventory from the hail. You could argue that's a non-recurring item, but at the same time, we decided maybe we wouldn't, remove that from the P&L because those insurance proceeds replaced, income that they could have generated from selling those vehicles that were damaged. So there's some subjectivity there. Maybe you advertised one year a lot, and those increase in advertising dollars didn't really come to fruition in terms of increase in revenue and increase in cash flow. And then the next 2 years, you decided we're not going to do that advertising campaign again. It didn't really work out for us. Well, we would smooth out that 1 year of advertising expenses that really didn't benefit the company, and you aren't going to expect to do in the future. And speaking of future expectations is a big item. Valuation is a prophecy of the future. You could say Adam and I have profits, but there's certain things we look at when it comes to future expectations of the company. First thing we do is we always talk to the owner of the business. We get an idea of where he sees or she sees her business going. And then from there, we ask for budgets and we ask for forecasts to see if those align with the interview or the conversations we've had. And we also kind of stress test those forecasts and budgets to see if they even make sense or they can even come to fruition. And so we do that by looking at the national economy, the regional economy. What's the economy doing? You've heard a lot about tariffs lately, and tariffs impacting companies in the U.S. Regional economy. If you're a Buffalo-based business and your business has generated a lot from the population and from per capita, well, my business is a lot more valuable if I'm in Houston or Austin, Texas, than I am in Buffalo, based on a growing population or just a growing economic city. Industry is one. The best example I think I could come up with is if you think about Blockbuster versus Netflix versus video on demand, and streaming services. Hopefully everybody on this webinar is old enough to remember Blockbuster, so I don't feel so old, but Blockbuster's value in 1995 was a lot higher than it was in 2000, and was a lot higher, much higher than it was in 2005, with Netflix coming in and eroding its market share and changing the industry. And then now Netflix, that has a competitor coming into its industry in terms of video on demand, streaming services, Disney Plus, Hulu. So the value of Netflix was up in 2010, and then it went down when you have competitors coming in. The industry is changing, and there's different options evolving. Yeah. Key customers is another one we like to look at. Let's say you're a machine shop, and you have 2 or 3 key customers that you produce parts for. You're providing parts to Moog and to Lockheed Martin. Well, if they're performing well, you're going to perform well. But if they're cutting back and they're not performing well, that's going to be a detriment to you and a detriment to your value through your cash flows.
Yeah, that one happens a lot. It's when you have those big recurring customers, it's great, but there's also significant risk. They're having that concentration where the work dries up from one of them. There's significant risk in your business being able to maintain those operations going forward.
Which is a good segue into the next few slides, but not there yet. Earnings capacity. Think about this as your ability to produce earnings or to capture growth. So, having an interview with an owner and them being extremely positive about where they could see their business going, and, there's a ton of customers out there, there's a ton of business out there to be had. Going back to the machine shop example, Moog is growing like crazy. They've been placing orders like crazy. Well, if you don't have the ability to capture that, that doesn't really, help you at all, because you can't just generate any cash flows if you can't produce the cash flows. And how does that, relate to your business? Well, you're a machine shop and you're already at full capacity. You already have your machines running at, at 3 shifts. You have no space. You have no capacity to, to capture that growth. Same thing with your workforce. If I can't find the people to do the work, Ed and I expect a ton of valuations from this, this webinar we're giving. If we don't have the time or the personnel to perform the work and capture that work, we can't, that cash flow is not there for us to basically obtain. If we don't have the ability to obtain it. And then finally, items not on the income statement, as I keep talking about cash flow. Capital improvements, depreciation kind of captures your capital improvements, but it's not the best representation of your actual cash you pay out in turn when you invest in capital improvements. Sometimes it is if you're a tax-based entity and you're using accelerated tax or accelerated depreciation for tax purposes. We need to fold back in your depreciation and actually put in your capital expense outlays to give you a true picture of your actual cash flows. And then finally, this term incremental working capital. As your business grows, you need to keep cash in the business to sustain that growth and to capture that growth. So if you're selling more inventory, you need to have cash available to buy more inventory, to hold more inventory on hand. If you have to tie up your cash in inventory, that's not cash that comes back in my pocket as an investor. That's cash that sits on my balance sheet or in my business. So the next few slides are just a quick example of kind of what Adam and I do when we do a business valuation as it relates to cash flows. The first half of that demonstrates the historical information of the business that we were valuing. I cut off the 5th year just because I couldn't fit it all on the slide. But you'll see we looked at 4 years and the trailing 12 months for 2025. And this is a good example of using a discounted cash flow versus capitalized earnings approach. You can see in 21 and 22, they were impacted by COVID. The revenue in 21 was 7.5 million, and then all of a sudden, for the trailing 12 months of 25, they're up to 20 million. So if we were to do the valuation in 21 and say, this represents future operations, let's use the capitalized earnings approach, we would probably understate the value of the business based on that specific situation. And it would be smart for us to forecast 22, 23, 24, and 25 based on discussions with the client and all the other things that I mentioned that we consider: national economy, regional economy, et cetera, et cetera, et cetera. But once we get to historical EBITDA, we kind of clean it up with our normalizing adjustments, and this relates back to those non-operating, non-recurring items. So you'll see there we had pretty significant non-recurring income that we removed from the historical EBITDA, and those were all PPP and ERTC proceeds. We removed bad debt from one customer because it was kind of an anomalous occurrence. It was a one-time thing where the customer didn't pay, but if you looked at their history and their trends from the previous 4 or 5 years, their bad debt expense was really never that high or non-existent. So a lot of times you may keep bad debt expense in there if it's recurring and normal, and it's, we see it every year, but in this case it wasn't, so we pull it out. Owner's compensation is your non-operating item. Again, this owner was underpaid based on fair market value of compensation for a similar role if someone were to come in and replace him. And we do that because at the end of the day, someone needs to run this business. And a lot of times we see when we do evaluations, owners kind of overvalue their business because of the cash they're taking out in form of compensation. But you always have to think about that compensation as a necessary expense, because at the end of the day, if I'm an investor and I buy your business, I'm going to have to either pay you or somebody else that replaces you your salary to generate the cash flow that your business is generating. So I see a lot of times there's a little bit of a disconnect between the value of the business and the fact that the owner is pulling out $200,000, $300,000, $400,000 in compensation. And thinking, look, my business is worth a lot based on the fact that I'm pulling in $400,000, $500,000 in compensation but that may be necessary compensation I need to pay for someone to run the business. And then once we get to the adjusted EBITDA, like I said, cash is king. We get down to a cash flow amount that we project by pulling out taxes based on that adjusted EBITDA figure, restating depreciation expense and capital expenditures to get the true cash flow, cash outflow for capital expenditures, and then also incorporating an incremental working capital figure into that to get to forecasted net cash flow. So that's 1/3 of the formula. A lot of inputs, a lot of analysis that goes into that. And like Adam said, one of the biggest value drivers. And so then the second third of the formula, discount rate of risk. Your discount rate reflects the risk in achieving the forecasted cash flows. So this is really all this is a mechanism for the investor to influence how much they're going to pay for your business so that they can achieve their desired rate of return, or so that they can limit their risk exposure to your business essentially. Because an investor cannot influence that 1.7 million that I forecasted. They can't guarantee that's going to occur. They can't fire people. They can't hire people. They can't tell you to use a different go in a different market. I suppose if they're 100% investor, they can tell management and hire management and fire management and have some influence. But in general, if you're a silent investor, you really have no influence over that $1.7 million being generated. All you have influence over is how much risk you're willing to take on. I think the best way to kind of illustrate that too is thinking about this as your required rate of return. So if my required rate of return is 20% and the business is going to produce $200,000 in cash flow, that means I'm willing to invest $1 million in that business to achieve a 20% rate of return. $200,000 return on $1 million invested equals 20% rate of return. Now, if I perceive a higher risk and I desire a higher rate of return, say 25%, well, I reduce how much I'm willing to invest, and therefore I reduce the value to you as the business owner who's selling your business. So if I require 25%, that means I'm willing to invest $800,000 in your business, because $200,000 return on $800,000 invested is a 25% rate of return. And then vice versa, if I perceive low risk and I desire a lower rate of return, or require a lower rate of return, say 15%, I'm willing to invest more cash into your business, 1.3 million. 200,000 return on 1.3 million is 50% rate of return. Oops. So what are the specifics of the discount rate? What are the factors that go into your discount rate? The best way to think about this is the law of substitution. There's other investments in the marketplace I can park my money. So knowing that, what is the required rate of return that your company has to give to me before I even consider investing my cash into your business? So what we use is the build-up method, where we take rates of return and substitute investments, and we come up with a base level of risk or base level of rate of return, and then add your company-specific risk premium onto that. So these three items at the top here, this is all based on empirical evidence and based on data that we pull in from our databases. The first one being the risk-free rate, 4.86%. That's the rate of return on U.S. Treasury bills, a 20-year U.S. Treasury bill, and it's risk-free since it's backed by the U.S. government. So I can park my money in a U.S. T-bill and receive 4.86% rate of return risk-free. The equity risk premium is the premium on top of that 4.86% that has been produced by S&P 500 stocks from 1926 to 2024. So from that about 100 years, S&P 500 stocks have returned approximately 11% rate of return in total, or 6.26% over the risk-free rate. So you need to give me 11% at least, because I can go get an S&P 500 index fund and get 11% in the perpetuity. Small stock risk premium is similar in terms of the theory as the equity risk premium, except this represents all those stocks outside of the S&P 500 basket, all those microcap stocks, small stocks, all those stocks outside that S&P 500 basket. Those have returned on average 4.4% over that 11% from the S&P 500. So your base level rate of return is 15.6% that I need to get before I even consider investing in your business as a privately held business. And then we get into company-specific risk premium. And these are risks specific to your business or to the business you're looking to acquire. I put 6% for a total discount rate of around 22%, 21.6%. we'll get into that in a little bit in terms of why I'm in that 22% range. But company-specific risk premium is what you should focus on as the business owner, as the person looking to acquire the business, because these are the risks and these are the premiums that you will add to that 15.5% if you're looking to acquire because you want to reduce value. Or as a business owner, you're looking to control and reduce and you want to keep your discount rate as close to 16% as you can, which isn't really feasible based on risks that are just inherent in small businesses compared to these publicly traded companies. But we want to reduce risk as much as we can. So what are our risk factors when we have a private company? Well, there's a litany. We'll go through each one. Financial condition. What does your balance sheet look like? Are you highly leveraged or do you not have much debt? Do you have a significant working capital? Are you in a good position in terms of your current assets versus your current liabilities? Do you have a lot of cash on hand? Do you have a lot of AR you haven't collected? Those are all the types of things we look at in terms of your balance sheet and your risk profile. Operating history, talking about profitability. Are you profitable? Are you consistently profitable? Do you have steady revenue, or is your revenue up and down? Are your earnings up and down? How steady are your operations? How reliable are they? Location. Landscaping business in Buffalo is a lot different than a landscaping business in Miami. A car dealership in Miami is a lot different than a car dealership in Cleveland. Industry conditions. Think about Blockbuster versus Netflix again. There's a lot higher risk profile in a Blockbuster video store in 2000 than there was in 1995 with Netflix coming in and eroding its market share and changing the industry. And that kind of goes back into the bullet point 2 under that competition. Is there lots of competition or is there little competition? If there's lots of competition, are you a market leader or are you lagging behind your competitors? Customer and supplier concentration. This is a big one that we often see when we do valuations. Are you reliant on a few key customers to produce revenue and produce income for you? If so, you have a higher risk profile. Same thing with the supplier concentration. Are you receiving or are you sourcing your supplies from a specific vendor? If you're a coffee shop and you get your beans from one area of the world, are those tariffed now? Or is there a bad weather event and all your bean supply is wiped out? Like that's a high risk. Depth of management, key person. This is another big one we often see with the small company valuations. The owner is usually the one with the customer relationships. The owner is the one with all the institutional knowledge. If that's the case and there's not many people behind him, or you haven't passed off those customer relationships to other people, there's a higher risk when you leave that I'm going to achieve those cash flows that I'm forecasting. Same thing with quality of management. I'm sure everybody on this call is a quality member of management. It speaks for itself. I don't really need to get into the detail of that. But as an example, think about the New England Patriots this year, which is hard for us as Bills fans to think about. But last year they were 4-13 with the coach Gerard Mayo. This year they're 11-2 with a coach Mike Vrabel. So quality of management matters. I know there's other things that relate to their success, but if you think about their coaches, you have a coach who has experience, who was good with the Tennessee Titans, came to the Patriots, and look at their record now compared to when you had a new coach there.
I love the football analogy in this.
I love football too, but I hate that I have to make an analogy that the Patriots are good. So.
Very true.
Just as a point of reference for you, a slide you can keep. I think that slide with the 3 gauges is a helpful slide to print and keep, and then this slide maybe too, just so you can kind of get a reference point of where discount rate usually lands when we do evaluation. This is all information that we obtain either from our Kroll database or from a Pepperdine report that you can get online. You can search this online, the Pepperdine Business School. You can pull that report if you want. You won't be able to access Kroll. That's a paid subscription, but you'll see in that green highlighted area, like I said, I fell in at 21.6% discount rate because we usually see discount rates of between 20% and 25% when we do these valuations. These are publicly traded companies, but you'll see the market capitalization of these companies in those ranges, 1.1 million to 304 million. And if you hone down into that, into that subcategory decile 10Z even further, that 1.1 million to $67 million type of business, their discount rates or their rates of return around 25%. Once you get above 25%, you're starting to get into that VC venture capitalist type of rates of return. You're getting into those startups, those seed companies, those small companies. That, of course, you would expect a higher rate of return required and a higher risk profile because they're new companies. And VCs build that into their entire basket of investments, because one may, be the ACV, of tomorrow and kill it for you, but then you have 10 that just don't do much. So you build in a general risk rate of 35% or 28% when you go to invest. And then finally, the last third of the value drivers is your growth rate. The key item to pull away from this is long-term and sustainable. So you have to think 20 years when you think long-term, you have to think into perpetuity when you think long-term. This is a long-term sustainable growth rate. So we're not talking about 5 to 10%. We're not really talking about 1%. A 5 to 10% annual growth rate isn't sustainable over 20 years. And a 1% growth rate isn't reasonable over 10, 20 years, because if you're only growing at 1%, you're going to be lagging, the rate of inflation, and then your company is no longer going to exist. So what do we look at when we think about future expectations for growth rates? Similar to what we look at for the other two that we talked about, national economy, regional economy, industry. Is the regional economy growing? Is it stagnant? Is it shrinking? Same with the industry. What are my key customers doing? Are they growing or are they shrinking? If I'm heavily reliant on, Moog and Lockheed, are they growing or are they stagnant? Or are they, because if they're driving my revenue, my earnings, they're going to influence my growth rate. It's also important to note that this growth rate is specific to your cash flows for your future benefits, to your earnings, cash flow, EBITDA. That bottom line number is not your revenue growth. You can have 10, 20% revenue growth, but if your bottom line isn't growing the same way, you're not going to achieve the same level of growth. Revenues usually grow a lot faster, a lot higher than earnings. Let's see earnings, because to develop or to capture that increase in revenue, you're usually having to put a lot of expenses into that, whether it be increases in salaries or workforce, et cetera. So what do we usually peg that growth rate to? What I like to look at is a Livingston survey that's produced by the Federal Reserve Bank of Philadelphia. And what they provide is 10-year forecast of real GDP and CPI. So real GDP is essentially just the growth in goods and services sales from year to year without accounting for the impacts of inflation. So this is just the volume of goods and services they sell at steady prices. CPI forecasts the growth in prices. So you combine the two, you get nominal GDP, which is essentially showing what is my growth in overall goods and services sold, and then what is my growth in the prices of those goods and services sold to capture total overall growth in my business or in the U.S. economy, in this instance with the Livingston survey. So using that 4.3%, we kind of use that as our peg or as our target. We're never going to go above 4.3%. Doesn't make sense. A company can't grow faster than the U.S. economy. Theoretically, if that was the case, your business would overtake the U.S. economy eventually. So we usually peg your growth rate around 3 to 4%. 4% is pretty high based on this 4.3% from the Living survey. So just think when you're doing this, usually around the 3.5 to 4% growth rate, because this is a long-term sustainable growth rate.
Yeah, growth in perpetuity. A year where you grow more than the government, but not sustainable in perpetuity.
And then finally, just kind of wrapping this all up and tying this all together, and I've left hopefully 10 minutes or so for questions. So what are some things that you can focus on then, and this is more targeted to the business owner than I suppose the acquirer, but what are some things you can start to think about now, knowing all of the value drivers and that information I presented to you about those? What are some things you can do now to set yourself up for the highest value or future success? I think that first bullet point under both cash flows and discount rate is a big one, cleaning up your financial data. I often see the cleanliness of financial data or the accuracy of financial data being kind of undervalued. I've been in situations and I've consulted where we're looking at financial data from a potential business we want to acquire or the client wants to acquire, and the revenue and the profitability just didn't add up. They couldn't give us answers. The business owner couldn't give us answers as to why or what was going on with their financial data. They weren't really aware of it. Their accountant didn't really know. Ultimately, the deal never went through because we couldn't rely on that financial data. So I think if you have clean and accurate financial data, that's going to set you up for success in the future, and is really important.
You could turn off buyers right away and then really put an end to that process.
Right, and like, what else does that say about your operations too? If you're, you know, it's not necessarily indicative of that, but you could maybe, you can maybe make that leap to say, you know, if your financial data is unorganized, you know, are your operations equally unorganized? Controlling discretionary expenses, I think, is a big one. Just to put this into perspective, every $10,000 you save in cash flow is $50,000 of value at a 20% capitalization rate. So if you save $10,000 today, you can make $50,000 in the future when you go to sell. Not to say you need a penny pinch, but if you're able to determine what expenses you really don't need to be making, if you're a business owner, you're being a little bit loose with some of the expenses running through your business, or what you kind of need to do is shift your mindset from a tax savings perspective to a value enhancement perspective. And as you know from this presentation, we look at 5 years worth of historical data. So we're going back 5 years, we're looking at all that, and we generally clean it up. But if you don't have clean financial data and you can't determine what expenses you're running through that are discretionary, that we can't pull out to enhance your value, well, that's value you're leaving on the table because you decided to take it out today instead of, you know, saving it for tomorrow, essentially. Discount rate, I'd say the biggest one is create a management succession plan. There's a lot of business owners who take everything on themselves, take on all their customer relationships, have all this institutional knowledge. The best thing you can do is start to plan for how you're going to reduce that risk by finding a replacement or coming up with a plan to start, you know, giving out some of those customer relationships to others, getting other people involved, whatever it may be, to not make yourself as reliant or make the company as reliant on you as it is right now. And then finally, with the growth rate, that's kind of hard to impact. You can enter new geographic regions depending on your business. I'd say the biggest thing right now is investing in technology and innovation. You know, how is AI impacting your industry and your business? AI may be replacing some of your services, which is a reduction in your growth rate, a reduction in your cash flow, but it also may be helping save expenses in terms of efficiency, replacing some workforce you don't need. That enhances your value too. And investing in marketing, do some advertising to help spur some growth in your business.
That's a great checklist to be able to provide everybody, and, you know, what should they be working on today for that future sale. So we're going to do one last poll here kind of as we're wrapping up, and if you want to put questions in the Q&A in the toolbar so that our experts can answer them, but I will, as you're doing that, I will launch the last poll of, based on what you learned today, how are you feeling? Hopefully we have nobody in the I am confused option, but let's see where they're at. It's a lot of formulas, but I think you broke it down nicely for everybody and some great examples. So give everybody just a minute to complete that and kind of see where you're at. As I said, I will send out this afternoon a copy of the presentation and a link to the recorded session. So if you want to go back and listen to it, you can, or again, share it with somebody. And don't forget about that exit survey. So I'm going to close this out. Looks like most people have voted, and I'll just share real quickly so our experts can see it. Looks like third or more are in good shape and on the right track, and the other ones have gotten the information they needed to get started. So that's awesome. I'm glad that we were able to help you in that process.
I was confused.
Yes.
Maybe they're being polite.
Or maybe you're just a really good presenter and expert on what you know. So again, feel free to drop any questions in for our experts. They're here for you. We have a couple more minutes before we get to the 1 o'clock hour. So take advantage of them being here with us. I will just also share with you some upcoming webinars that we do have. One that I did not put on here, December 9th, we have Profit and Protect Small Business Growth Blueprint Panel. Our expert, Lisa Merkel will be on that one. December 6th is the fourth in this series of Planning with Purpose, getting your company ready for transition. And we have a brand new one that was decided on yesterday, so you'll be seeing some marketing for it, is December 18th, the OBB update. So kind of just reviewing what we talked about in our July webinar and giving you some updates and clarifications that have come out since, and also just kind of review some things for your 2026 planning. So those are some webinars coming up. I will share those links with you. Here's the contact information for our experts and QR codes for our past webinars. And also if you want to follow us on LinkedIn so you can get updates as they're happening. And we want to thank our experts today. Thank you for joining us and going over all that and giving us some real tangible things to work on for their businesses. Thank you for joining us today, everybody, and have a great afternoon.